Well, hello everyone and welcome to Moementum channel. My name is Mo, and in this video, as part of our weekly stock market investment portfolio, we have an exciting video ahead of us. First, we're going to quickly take a look at where our stock portfolio is, but before getting into it, we'll walk and share with you a quick excerpt from recent article that has been published. The article is based on an excerpt from a finance book that talks about the importance of compounding and how investing in the stock market can really pay off over the span of the long term. So we're going to take a look at that and ultimately walk you through the exact transactions that we've had in the stock market in the past week, what stocks we bought or sold, and of course, where our portfolio is in our journey to growing this portfolio to $250,000 within the next 7 to 8 years. Without any further ado, let's get into it. All right, as I mentioned early on, there is a finance book that I was referring to called Everything You Need to Know About Saving for Retirement. This is a book by Ben Carlson, and it is available on Amazon. But Ben Carlson just recently, a few days ago, actually published an article in his blog and website called Wealth of Common Sense, where he talks about how the stock market works. And as I was reading through this article, there are a few key points that I found quite interesting and worthwhile reviewing it with our audience here. So we wanted to quickly talk about that here. I'm just gonna take a look. One of the key points that Ben makes in this article is about the difference between investing in the stock market versus casinos. He mentions many people compare the stock market to a casino, but in a casino, the odds are stacked against you. The longer you play, the greater the odds you'll walk a loser because the house wins based on pure probability. But it is just the opposite in the stock market. And he's talking about the value of time and how time and compounding can actually play to your advantage in the stock market over the long span of time. And in this case, of course, you're not necessarily talking about picking winning stocks, but rather investing in the stock market as a whole. He talks about the longer your time horizon historically, the better your odds are at seeing positive outcomes. And of course, he talks about how there are going to be fluctuation in the stock market over time. It's not that always going to be roses and everything is going to be fine. There are time horizons in the stock market whereby you might have even double-digit losses, but over the span of long term, it's going to pay off. In fact, if you look at it, he talks about it's been possible to lose money over decade-long periods in the past. Even 20 to 30 years results can see a big spread between the best and worst outcome. However, it is worth noting that even the worst annual returns over 30 years in the history of the US stock market would have produced a total return of more than 850%. This is the beauty of compounding, and the worst 30-year for the S&P 500, for instance, gave you more than 8 times your initial investments, which is just remarkable. Moving on, he talks about the fact around looking at these big gains and massive gains can be quite impressive and might make us think that investing in the stock market is just a no-brainer, which while it is a great option for many people, it is also important that we shouldn't forget the importance of having the right attitude and right mentality around it, because it is easy to get carried away with the positive returns when you see, forgetting about how it requires certain discipline to not panic, to not or make an irrational decision along the way as you see some massive ups and downs throughout that journey. It's definitely a roller coaster for sure, to say the least. For example, if you look at here, what is indicated here is that $10,000 invested in the S&P 500 in the year 2000 would be worth $37,600 by September 2020. Or if you invested the same amount of $10,000 in 2000, it would have been worth $34,200 by September 2020 in about 20 years time frame. As you'd see here at different time horizons, how the amount might change. Obviously, the longer you were in the invested, that could have resulted in a better return, exactly because of that compounding interest. For example, if you had invested $10,000 back in 1960, by September 2020, it would have turned into 3.4 plus million, which is just incredible. However, the point that I was alluding to earlier is about how those ups and downs could happen. The $1 invested in 1950 would grow to $17 by the end of 1972, and subsequently dropped to $10 by the fall of 1974. From there, it would grow to $95 by the fall of 1987, and only to drop to $62 over the course of a single week because of the Black Monday crash. So this is really the key point that I'm going to make, and actually the point that Ben in his article is really alluding to here, is that investing in the stock market requires that discipline and the acceptance that it is going to involve pullbacks. It is going to have those glorious days, but also it's going to have those awful days where you're gonna regret the decision of why you started investing in the stock market. So you got to be patient, and you have to have that longer term horizon when it comes to investing in the stock market. As the article even suggests and mentions, this post is based on an excerpt from Everything You Need to Know About Saving for Retirement, and was originally posted on February 21 of 2021. If you're interested to read that book, I'll definitely leave a link in the description of the video, so be sure to check it out. All right. With that out of the way, let us go ahead and take a look at our latest and last week's transactions, what stocks we bought or sold in this past week in the stock market. As we talked about it earlier on, there were a couple of stocks that we had intended to buy or sell in this week. We had quite a bit of them. So you notice here we had several fractional shares buys. For example, Royal Bank of Canada, we've bought several fractional shares. Bank of Toronto Dominion Bank, actually, we had another fractional shares as well. You notice here, Shopify, we've been continuing to add through the fractional shares. What else we've done? We've actually bought shares of Real Matters. Real Matters had a huge decline past week after they announced their quarterly earnings. And although the quarterly earnings was not necessarily that bad, the stock market and overall the investors kind of reacted very negatively to it. As you notice here, Real Matters over the past 1 week has gone down by about 17%, which is a massive decline. At one point, it was trading closer to $15 or $16, and now trading at closer to $12 or $13. So definitely a huge decline. We've been trying to take advantage of that and actually add to our existing shares, buying more shares of Real Matters as a result of that, which you notice here. We've bought at $13.45, $13.55. We bought also 2 shares at $11.50, and definitely adding to our shares. We got one more share at $12.66. Aside from that, we also bought 1 share of EAGB, or Emerge Arc Genomics and Biotech ETF, at the price of $22.65. And we sold our shares of Store Capital. We had 1 share of Store Capital. We tried to sell it at the price of $36.60 USD. And we also sold our 5 shares of Drone Delivery Canada, and currently don't have any more shares of that. We sold it at the price of $1.36. With that, let us take a closer look at our portfolio and what holdings we have here. You notice here, this is ranked based on the highest percentage gain all the way to the lowest ones. About 2/3 of our holdings in terms of the counts are actually in positive territory, green territory, and the other 1/3 is in negative territory. The best performing 5 stocks that we have here include CrowdStrike with a positive return of 159%, followed by Ryokan with a positive return of close to 50%, followed by Artis Real Estate, again another 50% positive return, and Skyworks Solutions with 46%, and lastly VCN, or Vanguard FTSE Canada ETF, which is showing a positive return of 45%. We have almost a tie though. If you look at it, on the sixth spot, we have AbbVie, which is also showing another 45% return for us. In terms of our 5 worst performing stocks or ETFs holdings that we have here, Plug Power is at the worst performance. It's showing close to negative 35% return, our 16 shares. We have Hyliion. It is showing a negative 29%. Green Lane Renewables is showing a negative 21%. Real Matters, the company that we talked about, is showing close to 19%. So this actually sums up the whole story. We were down 17% last week, and we are now showing 19% overall. So we lost a lot of the grounds that we had earned over the past couple of weeks, and this past week has been horrible for our holdings of Real Matters. But we've been adding to our shares and still believe in the company longer term. Corsair is on the fifth worst performing spot, which is showing a negative, close to negative 18% return. In terms of the week ahead, we are going to continue to take advantage of dollar cost averaging and buy the shares of these companies that are in red territory, especially the ones that are in Canadian dollars companies. In particular, we are thinking of adding gradually to our shares of Greenlane and Real Matters. We might be adding as well to our existing shares of CARS, which is Evolve Automobile Innovation ETF, as well as the Emerge ARK Invest ones that we do have here. VMed is another one that if the stock price drops, we might be adding as well to our existing shares. Ultimately, the longer plan for this portfolio is to trim some of our holdings and focus on more manageable handful number of holdings. Currently, based on our counts, we have closer to 47 to 50 holdings at this time. If we take a look at our overall overview here, we notice that our overall account balance is sitting at $25,549. Our deposits, if I quickly show it to you, last week we had a couple of deposit points. So you notice we deposited closer to $175 to $200 last week. Those deposits that we made managed to kind of cover some of the losses that we had in a sense, and otherwise our account balance would have probably been worse. But again, it actually goes to exactly show you the point that I was sharing with you through the article from Ben earlier on around those declines in the stock market. Those are some of the realities of the game that you have to accept, and at the same time you shouldn't necessarily panic. And I think that's a true test for us as well, and how we are going to approach this. We don't intend to buy any of our holdings or stocks at this stage at all when they are in a negative territory. In fact, if anything, if we believe in those companies, we want to add more and take advantage of dollar cost averaging. Our overall average dividend yield is currently sitting at 1.57%. This portfolio is made of both dividend and growth stocks, and our dividend yield is at 1.57 at this time. Our expected annual dividend income is at $390, close to $391 annually, and the dividend income, average dividend income by month, would have been around $32 or $33 if we look at it. And so far, we are showing an overall return of 35.5% for this portfolio, but within about 2 years time frame. And our overall dividend income in this portfolio, since the beginning of the time and since we established this portfolio, is at $425 dividend income. Looking at the dividend history, you notice here that for the month of July, we earned $22.63, which was lower than the past 2 months. In fact, in the month of May, we had $35.55, and in the month of June, we earned $34.42. We'll have to wait and see how our dividend income is going to shape and in the months of August. We definitely are excited about that and see. Looking at our latest dividend income, so if we quickly take a look at it, we earned $14.40 from Bank of Nova Scotia last week, which is just incredible. We also earned 23 cents from 𝗖𝐋𝐈 and 69 cents from XDV. Those are our latest dividend income. Well, there you have it, folks. A quick look and review of our stock investment portfolio that we have here with Wealthsimple Trade. If you do not have an account with Wealthsimple Trade, you might want to give that a try. It is a wonderful brokerage account that I've been using, and it allows you to buy or sell any stocks or ETFs in Canadian dollars that they qualify, that they are actually available on their trading platform for no charge. So it's Canada's first commission-free platform in that sense. For the US dollar stocks or ETFs, you are going to have to pay a conversion fee, and that's something for you to be aware of. If you are interested, be sure to use our referral link that is available in the description of the video. Currently, they have a promotion, and if you sign up using the referral link, you would get the cash value for 2 stocks by random. And the value of the cash value for those stocks could be anywhere between $15 all the way to $4,500, which is just remarkable. Wealthsimple Trade also offers you the option of fractional share trading. It's a new feature they've added. It is only available for a handful of stocks, but I would imagine over time they would grow that and build a larger inventory of options for you to be able to buy or sell stocks or ETFs through fractional trading. Thank you so much for watching this video. I would love to hear from you and know what stocks or ETFs you're planning to buy in the stock market in the week ahead. Let us a comment down below and share. If you gain something of value from this video, please be sure to give this video a thumbs up. And of course, don't forget to subscribe to Moementum channel. Here on Moementum, we post every week several videos about investing in the stock market as well as financial freedom. Thank you, and we hope to see you next time.